Hello and welcome to Charting the Markets. It's Wednesday, the 22nd of February. And certainly if we look at European markets, they're continuing the risk-off theme that we have been seeing dominate recently. That comes off the back of a set of PMI readings come out of both Europe and the US yesterday, which pointed towards relative strength. Certainly the initial reaction was strength here for the pound as we saw upside moves in both the services and manufacturing readings. And that, of course, led to a nice pop in terms of construction moving into expansion. And suddenly we started asking ourselves, what recession? But that doesn't necessarily mean that the UK is out of the woods quite yet. And certainly the downside that we're seeing at the moment also alludes to the fact that good data is seen as a negative for markets at the moment. If we see strong numbers in terms of jobs, as we have seen recently, retail sales, as we have seen now PMI readings, that essentially means that the central banks can focus on inflation and say, well, everything else seems to be ticking along very nicely, and therefore we can continue to push rates higher and maintain them for a longer period of time. The expectation is that at the back end of this year, we're going to see the central banks really focusing on the potential for them to turn around and lower rates once again. That just wouldn't be the case if we saw the economy powering through, and certainly if we saw inflation not back around the sort of target region, 2%, 3%. If inflation remains sticky and if the economy remains resilient, then it's unlikely we're going to see any sort of pivot, and that means trouble for the stock markets. Coming off the back of this big rally that we've seen recently, we're really starting to see market sentiment take a turn for the worse of the moment. Certainly in terms of what's happened today in terms of the economic calendar, the focus has been on the RBNZ with a 50 basis point rate hike from that New Zealand central bank. By and large, we didn't necessarily see a huge kind of move against the US dollar because it was dominated by that risk-off sentiment that we have seen. For the rest of the day, big focus going to be on those Federal Reserve minutes as we try to ascertain exactly what the outlook is. As we say, strong data, does that mean that we're going to see higher for longer interest rates from the Federal Reserve? So that's going to be a key one going forward. Looking at the indices space, we have seen the FTSE 100 turning sharply lower. That comes off the back of a period where we couldn't seem to do no wrong, essentially just hitting record highs on a regular basis. You can see the turnaround that we're looking at here on the daily time frame, certainly a sharp decline coming into play today. The daily time frame also highlights a trend that we have in play here that I'm just going to show you on the weekly time frame, but we have a very clear wider bullish trend. And so as we're seeing the weakness here, we're looking at a question mark around, are we seeing a top here? Are we just seeing a short-term move? And really, it's a case of being able to drill down into the relevant time frame to tell us exactly what this move could be. Certainly within this wider time frame, you can see that for months now we have been really regaining ground, but that doesn't last forever. And the daily time frame does highlight the trend that we have got in play here with the move higher pushing through into the back end of November, the pullback, the next leg higher, the pullback, the leg higher. Now we're seeing the pullback. So essentially the way that I see it is if we break back below this low around about sort of 77.11, something like that, 7700, 7712, that kind of area, that swing low is going to be really important. If we break that low, that's when it looks like we're going to see a wider protracted move coming into play. But until that happens, the pullback we're seeing at the moment looks like it could be a short-term phenomenon. There is a caveat to this, and that is that we've been seeing such a protracted move higher that at some point we're going to see that wider pullback. But until we see that 7712 level taken out, we're expecting to see some support come into place soon enough. In terms of the DAX, we can see that the daily time frame highlights again a similar big outperformance over the course of the last, say, 4 to 5 months. And we're starting to roll over. Crucially, we're rolling over into an area of support that would take us into this 152.44. Now, if we break that level, bearing in mind that we haven't managed to sort of rebound off that level and then push into a new high, if we break through that level, we'd be looking at a potential double top formation here. Well, multiple tops here, but certainly you can see here on the 4-hour chart the gravity of that support level. However, if we break that support, then we're going to be looking out for the 149.03, and certainly it's that level that needs to break for us to provide a signal that we're going to see a wider protracted move into, say, the 145 kind of area or the like. But certainly for the near term, 152.44 is your key level to be looking out for, because if we break that level, then it looks like we're going to be seeing further downside to come for this index. And then looking at the Nasdaq, in terms of price action, it has been leading the declines. Bear in mind that if we're talking about the idea that we're going to see interest rates higher for longer, that particularly hits tech stocks. So that would mean that we'd be looking for this index to really lead the declines, and that's exactly how it has played out. The double top formation that we can see here with previous resistance turned into largely support 122.58, but realistically that double top neckline is a little bit lower than that. You can see it's around about this 122.02. Well, that's been broken now, so that points towards a sort of reversal back in the direction of the wider trend. Certainly we did see this sort of double bottom formation, but as I've been saying for a long time now, we didn't break through that price swing low. So we could be retracing this wider move, and ultimately the retracement of that sell-off took us into the 76.4 fib recently, and we're heading lower as a result. With the fact that we've broken through that 122.02 support level, I'm expecting to see further downside coming into play for this market, with a break up through this recent swing high of 123.85 required to provide a little bit more of a neutral tone for this market. Until that happens, I think it's likely we're going to see the Nasdaq continue to be at the forefront of the losses for equity markets. Looking at the FX space, the US dollar has understandably come back into the forefront of the traders' mindset as we see equity markets roll over. So that safe haven play comes back into play once again. It's also notable that whilst we have seen US inflation moving towards a downside in a more meaningful manner than, say, what's happened in Europe, that started to slow somewhat recently, whereas we've been seeing a ramp up in terms of the decline in inflation in, say, the UK, which we just didn't have before. So we're seeing Europe really playing catch up in terms of that decline in inflation. And again, that provides the basis for a little bit more strength in terms of the US dollar as well. So we're seeing downside here, reflected here perfectly in terms of euro dollar. What we can see here is this respect on resistance on this simple moving average. As we can see here, that this is the 50 period moving average on the 4-hour chart, and so we can see resistance tapping away against that moving average and rolling over once again. So, you know, if we look at this from this 4-hour perspective, what we can see is a very clear trend of sort of lower highs and lower lows. From the wider perspective, we can see that we're only really in the inception of a bearish turnaround following a multi-month period of gains for this market. Says a lot about, you know, a number of different markets, because it's a similar kind of thing to what we're seeing in equity markets. In terms of the daily time frame, we can see that we're sort of losing some of that ground that we have recently gained. But crucially, from this perspective, we can see that 104.83 level is going to be really key. If we break that level, then it points towards a wider pullback for this market coming into play. But certainly for the near term, as we saw on that 4-hour chart, does look likely we're going to see further downside for the day ahead for euro dollar. In terms of cable, we can see to some extent a similar position, and in that we have been reversing some of the gains that have happened over recent months. But a couple of things to point out here. Firstly, we didn't manage to break up through the prior resistance level, so you're looking at a potential double top formation. On this occasion, it's going to be a neckline around about, let me just grab this horizontal, your neckline's going to come in around about 118.41. So much like with euro dollar, we've got that swing low. On this occasion, the swing low is also the neckline double top formation, because we didn't break through resistance, and therefore there's a risk that if we break 118.41, then we're going to look at a wider capitulation in terms of this market. So, you know, we have been seeing some downside, and the weekly time frame shows you, you know, we've seen one big week in particular. But we've regained so much ground that there's plenty of downside space to move into if we see this market really ramp up the losses. In terms of this move, we have seen a sort of pop here with this sort of inverse head and shoulders formation, but to me it looks like a retracement, and we're starting to roll over once again. This is the 61.8 Fibonacci resistance area that we came into, and now we're starting to roll over. So unless we break up through this resistance level 122.70, I think this near-term rebound is likely to falter once again as we see the US dollar coming into prominence. And finally, the New Zealand dollar against the greenback, and certainly despite the fact that we've seen the RBNZ raise rates by 50 basis points, people didn't really care that much, and there has also come a warning that we could see a 9 to 12 month period of contraction for the New Zealand economy. And so doesn't necessarily fill you with confidence and makes people want to move into havens, and that's why the US dollar is doing so well. Double top formation here with the neckline just below where it's currently drawn on there, 61.91. So that is yet to be broken. We can see that we tagged it previously on Friday, coming back towards that level. So 61.91 certainly the key support level to look out for below, but certainly you can see this capitulation, the consolidation sort of retracement phase, the breakdown through that swing low gave us that next leg lower. We've retraced around about 50% here, rolling over once again. I'm expecting to see further downside. Be aware of the fact that we do have that 61.91 level to look out for. So certainly more bullish with a move through 62.62, but it's likely we're going to see further downside, and a move through 61.91 really should ramp up that move for the New Zealand dollar. Looking at the commodities space, we have seen a risk-off move in terms of equity markets and the FX markets. What does that do in terms of gold? Because historically, people always point towards gold as this safe haven play. That's not necessarily the case this time around. The difference is that in the past, when we've seen economic crisis, people expect to see the central banks immediately cutting interest rates. This time we're seeing a crisis as interest rates are raised. We're just seeing strength in terms of the US dollar and weakness in terms of gold. And therefore, as we see markets come off, so we expect to see the same in terms of gold. So we've seen this big ramp up, very similar to what we've seen in terms of equity markets and in terms of some of the FX markets. And now we're starting to see that come off in a meaningful manner. Bear in mind this wider time frame that we can see on a monthly chart is very bullish. Now, for me, I think that what we're seeing here is a precursor to another leg higher. I'm expecting to see this really outperform. But there's two things we need to see for that to happen. Number one, we need to see the economy start to essentially fall apart. We need to see a recession and the like, something that central banks would need to remedy. And number two, we need to see inflation coming back down towards target. That would then start to shift rhetoric at the central banks and have them talking about interest rate cuts. And historically, when we see interest rates being cut, gold does particularly well. And so for the near term, we're talking about not interest rate cuts, we're talking about hikes. We're talking about the economy doing relatively well. And therefore, we're seeing this market coming off because people are fearful, well, it could be some time before we move into that phase. The economy isn't doing necessarily that well. The economy is doing well. That allows interest rates to be raised once again. That gives strength for the US dollar. And therefore, I'm expecting to see the dollar strengthen. I'm expecting to see this be the beginning of a period of downside for gold. But for the long term, in terms of investors, I do think that's going to be an area where people can sort of start to accumulate equities aligned with the idea that we could see the potential for upside in terms of gold. That's how I see the longer term picture playing out. But there's a number of caveats that come alongside that. Like I said, most notably, the idea that the economy has to move into a period of weakness to force the hand of the central banks. That's not happening at the moment. And so certainly one to watch out for, but from a technical standpoint, we can see that this market has been rolling over following a protracted period of upside. And now we're moving into what I would consider to be a likely sort of relatively clear-cut phase of downside. So what we're seeing here is a sort of stepped move lower. Let's just sort of tag each of these swing highs. So we can see the step move lower each time, creating this new swing high and then moving into the new swing low. So more recently, we've rallied into 1847. We don't know that that's necessarily the swing high because we haven't broken into a new low. So as things stand, 1871 is the key line in the sand. If we break below 1819, then that would shift down into 1847. So as long as we continue to create this stepped move lower, I'm expecting to see further downside playing out for gold. And then looking at Brent crude, certainly energy markets remain really crucial here. This is our trade of the week for last week, and it's been working out very well because we had descending trendline resistance coming into play alongside Fibonacci, and we've been rolling over ever since. Certainly if we break down through this support level of 79.04, then you got this sort of head and shoulders formation and a further move towards the downside. Certainly worth bearing in mind that the US have been talking about topping up their strategic petroleum reserve around about your $70-odd mark, but as things stand, they continue to draw it down, and therefore we're likely to see further weakness. So certainly, as things stand, it does look likely we're going to see further downside playing out here for Brent crude, and the 4-hour chart signals exactly that. The breakdown through your support level here at 81.62 signals the expectation that we're going to see further downside following the sort of head and shoulders formation that we've seen playing out here, with a break up through the 84.06 swing high required to negate that bearish view for Brent crude. That's it for today. If you want any more news and analysis, make sure to go onto the IG platform. Other than that, follow me on Twitter. My name's Josh Money here at IG. Have a great day and good luck trading. Thank you.